Good morning, everybody. It's Hammer. Today is Friday, November 14th, 2025. I, of course, am the founder of Originator Success, Grab and Go Social, and Rate Sensei. Glad to have you here this morning, joining me live. Remember, you can join me each and every weekday morning, 9:30 a.m. Eastern Time. This morning, coming to you from Austin, eating breakfast. Check these out. Look at these. Hold on, I got to flip the camera now. Look at those. Those are some good breakfast tacos this morning out here. Bad timing, but it is what it is. So thank you for joining me for breakfast. If you're here this morning, say good morning. Let me know. Can you hear me okay? Megan Bissell. Good morning to you. Let me know if you guys can hear me okay. If you're watching the replay, don't forget, give me a hashtag replay in the comments. Let me know that you're here. Good morning, Amber Moser. Remember, if you would like a quick text alert that I'm going live and a reminder, you can sign up for that at hmmr.io/reminder or use this cool QR code over here to sign up as well. So who else we got here this morning? Got Randy Tico. Good morning, sir. We've got Will Patterson. Good morning. Appreciate you letting me know about the sound, Will. Mallory Fotiatis. Good morning. So awesome. If it gets too noisy, let me know. And we're going to keep it short anyway. So good morning to all of you. We got a little bit to cover, so I'm going to jump in and we're going to go ahead and get right in on it. So Vicky McSweeney, Robert Bashir, good morning, y'all. Hope you guys are having great. I'm going to hop in. Let me share my screen, show you what we got going on this morning, kind of where we're at. So quick, we'll start with a recap of what happened yesterday. Bonds lost ground yesterday through the afternoon. So if you take a look here, you guys should be seeing it. You know, let me make sure. Let me pull this screen up a little bit so I know you guys are definitely seeing what I want you to see. Here you go. So taking a look here, pricing comes out right around 10 a.m. and mortgage bonds are right about here. And then through the day, they lost ground. It wasn't enough to see reprices worse, which is good, but it didn't look like we were going to get a great open this morning. However, what's nice is that we do have a nicer thing today. Rate sheets are likely to be similar to yesterday, maybe a little bit worse, because you'll see that we had a nice recovery this morning. You see it right here, and bonds basically, if we draw a line across, they're basically at the same level as what we were looking at around 10 a.m. yesterday. So that's going to put us in a position where rate sheet's going to be very similar to what we saw yesterday, and that's very much in the range of what we've grown used to. As we take a look at this stuff, you could take a look and see that the basically right in those 6 3/8 area is what we've grown used to. Slightly better rates coming off the holiday, and then they got a little bit worse yesterday, and then today you're going to see something similar to that. So that's kind of where we're at as far as where things go this morning. What's driving things, the reason that we are seeing that bonds are up these whopping 10 basis points here, and the reason that we're seeing the 10-year Treasury yield has fallen back down, currently at about 4.10. You can see it here struggling to break back below that what's now a resistance level for the 50-day moving average. And the reason that we're seeing that is basically due to what's going on with stocks. Stocks are selling off, a lot of tech stocks. You got the AI stuff going on. It's not a big move, but we are seeing a little bit of a flight to safety, basically, kind of where things are at here and moving it. So stock sell-off deepens as Fed fear rattles traders. Now this is what we want to be watching, because I've warned you the last couple of days that if we see expectations of a December Fed rate cut start to fade, and that's this column right here, if we see that happen, that's going to go ahead and it's going to pressure rates. Now, you could say, Hammer, if you're telling me that when this goes down, rates are supposed to get worse, but then you're showing me on rate sheets this morning that we're up, 9-10 basis points this morning, that doesn't jive. And the reason that we're seeing that, and that's why I want to be very clear on all of this here. So let me stop sharing and go over here. So what we're seeing today is you're seeing bonds improve because of concerns over what's going on with stocks. The fact that we had the Fed speakers come out and they're really putting a lot of questions about the rate cut in December. It was a gimme, and now it's not a gimme, right? And that's why you saw mortgage bonds lose ground yesterday. And it's why the door is open as we head into next week where things could get worse. It's why I would be locking loans today instead of waiting to see where things go. The reason we're still improved on the day is because of what's going on in stocks, and there's money being moved into bonds, especially over a weekend, as stocks are losing ground in a very heavy manner right now, especially those tech stocks, AI stocks, NVIDIA, all that stuff. So we're getting a little bit of a benefit from that this morning, and it's giving us a false positive, that looks like things are good. It's kind of throwing us a lifeline for the moment, but it's likely that's going to disappear. I'm going to throw the screen back up again so you guys can read what I read, and we'll go over some of this for a minute. But taking a look at what's here, this whole thing right here is kind of summarizes it perfectly, right? So Fed doubts grow over December rate cut with Kashkari on the fence. Kashkari is just one of the Fed members, and the hawkish Fed members are really coming out. Fed Reserve Bank of Minneapolis President Neel Kashkari said he didn't support the U.S. Central Bank's last interest rate cut. Said the anecdotal evidence and the data we got implied the underlying resilience in economic activity was more than he expected. And he joins other officials who've expressed skepticism over the need for another cut in December. And that's kind of the thing. Now, a lot of times, too, even though this is an end of year cut, officials don't care if they cut in December, or it's very likely we could see them take a break. And then we'll see more activity for the January rate cut. So when we look at expectations of a December cut right now, that December cut is about 50%, right? That didn't do what I wanted. There we go. So let me make this a little bigger so we can see it, right? So that December cut is about 50%. If we go to a January cut, it's higher because you're still at 50 here, but you've got the extra 20% that it would be a cut on top of. So you're at about 70%. And I think that's what's going to happen is we're going to see expectation of a December cut fade away. We're going to get some data next week. When it comes to the labor market data, they've already said that we're going to get labor market data, but it's not going to have unemployment because they couldn't do the surveys. So when we get jobs data and it gets released for October, there was no survey. So we still need to get the September data that would have come out October, I think it was the 5th. It should be a full report, but the October data that we would have gotten at the beginning of November, that's not going to have the unemployment factor to it. So, but basically where things are set up, we're going to have more Fed speakers today. We could see things lose ground as the day goes on, depending on how bonds react to those Fed speakers. So I'm going to say reprice risk on the day is moderate. Let me go ahead and type that in here. Moderate. And so reprice risk on the day is moderate. And if I'm locking loans, it's just like I've been the last couple of days. I would be locking anything that's closing in the next couple of weeks. Anything that's closing in November, I'd be locking. Anything that's closing early December, it's not a bad idea to lock it, especially if it's risk averse. We're not in a position right now where the forecast is open to seeing things improve. Now that could change if we get some of the data and the data starts to show that things are weaker than what we were expecting. If economic data, is showing weakness, if the labor market data shows softening to the labor market, that could open the door again and pressure for the Fed rate cuts. But I think what we're going to see happen as we head into the end of December, I think we're going to see the idea that Fed rate cut is coming. We're going to see that dwindle, and I think that's going to put us in a position where you're going to see rates just creep a little bit higher. We're not going to see rates jump. If you've got loans, people out looking, you want to be having those conversations, but you don't have to scare them. We're not going to see rates jump up or anything crazy. I don't like it when my hat's crooked, but we are going to see some movement. So there you go, my friends. I hope that helps today. Let me know in the comments. Robert says he feels like we are teetering on following the 6 versus 5.5. It's funny. Let's take a look together and see. It doesn't really matter. I mean, I think Matt Graham and MBS Live, I think he's following the 5 right now. Whatever coupon he puts a little star next to, he's actually following the 5. And, I know what you're saying. Basically, when you follow the coupon, historically, anything 3/4 of a point to a point and a quarter above the coupon value is where you're generally seeing rates. So a 5.5 coupon is going to see loans that are 6.25 to 6.75. So you could actually argue that we would be closer to the 5 coupon. I don't think we have to worry about being in the 6, but even if you look at the 6, you'll see some movement here. But there's lower trading on this one. The 6 coupon would put us at 6.75 to 7.25 without loan level price adjustments. Without the loan level price adjustments. So I don't think that you have to. I mean, it doesn't really. You're not going to see a big difference in performance on the coupons anyway, but I don't think you have to worry about the 6. It would be right now we would actually be between the 5 and the 5.5. I stuck with the 5.5 because it's got enough trading volume and it's been consistent. Randy said, I thought rates would be improved by now if asked a year ago. A lot of people have thought that, but we don't. Even as we head into next year, there's no reason to see rates move that much lower. I know that Trump is championing the idea that rates would be lower, that mortgage rates should be lower, that all rates should be lower. But there's no economic reason to expect that rates are going to be lower yet. When it comes to the Fed, they feel that they're very close to a neutral rate, and that their rate is just somewhat restrictive. And I think we have to worry about the idea of inflation, especially if they do something like throw $2,000 into the pocket of people out in the public. That's going to creates more demand. It drives up price. It's not a long-term inflationary effect, but it pressures prices and it pressures inflation. These are things that we don't want to see happen, in my opinion. But what are y'all doing this weekend? I am finishing up here. I am at Consolidated Coaching with my friend Scott Groves. If anyone wants to learn more about needing some help, you guys know I have lots of friends in the coaching space. Christine Beckwith and 2020 Vision, Your Success. I'm friends with Kai McBride, but Scott, they all have a different technique, something different that they bring to the table. And I really love some of the things that Scott does with Consolidated Coaching. So if you have any questions, let me know. He's got a really affordable program. They focus. I love what his focus is on lead gen and things like that. So, but we're here at this live event. In fact, Amy Blauser and Angela, Amy and Angela are here, so I get to meet them. I got to meet them last night. That was a lot of fun. But if anyone else, what are you guys doing? Let me know in the comments. Yeah, Robert said, it's funny. You give money to make money more expensive. It's what happens. Hi, Tiffany Teal, Mike Tebow. Tim Klyla. Tim, Danielle brought something up to my attention. I'll look at it closer when I have a little bit of time. I think, but let me know if there's any concerns. Danielle, I just want you to know Danielle's on top of your situation, and she assured me that everything is good. I don't know the details, but I do know that. So just wanted you to know that she's there and we're on top of it. So, all right, my friends. Well, I will see you on Monday. Although I don't know what time I fly out on Monday. Monday's going to be a crazy day. Bear with me because I get home Sunday night and Monday morning I fly to San Diego. I'm flying to San Diego. So there's a chance I might not be live on Monday. But anyway, happy birthday, or happy anniversary, Holly. So thank you, Ms. Winnie. And you guys have a fantastic weekend. Holly Johnson, congratulations, 26. I am at 28 myself, so it's good for you. It's amazing. Thank you, Tim. I appreciate you. If it's a question that you need me, just tell Danielle. Again, I'm going to be out of the office for the next week, so but keep me posted, and y'all have a fantastic Friday, my friends. I will catch y'all later, and thank you. All right, take care, everybody. Bye-bye.